In this video we are going to talk about the top 10 best dividend stocks to buy now. Before starting this video, please like this video and subscribe to this channel for future updates. The year 2021 has been a lot more stable than its chaotic predecessor, but a steady rotation to value appears to be in action, with growth stocks now significantly more abundant as the economic recovery gets underway in earnest. Moreover, despite the mounting concern over the continuous rise of the 10-year Treasury yield, it still lies below 1.7%, which is historically very low. As a result, equities with high dividend yields continue to be more appealing than the average. This is reflected in this annual ranking of the top dividend stocks to purchase for 2021. Every December, News & World Report publishes its predictions for the coming year. Here are top 10 the best dividend stocks to buy now. Number 10. Mondelez International, MDLZ. For various reasons, this $87 billion snack food behemoth is one of the finest dividend stocks to purchase in 2021. First and foremost, the company is extremely steady, which is exactly what most income investors look for in dividend stocks. Mondelez boasts widespread brand recognition and loyalty because to its portfolio of brands, which includes Oreo, Cadbury, Toblerone, Hall Sweets, Trident Gum, and Tang powdered beverages. Second, with 73% of its revenue coming from outside North America last quarter, Mondelez is an excellent way to add some overseas exposure to your portfolio. MDLZ pays a 2% dividend and has a payout ratio of 46%. Number 9. Cisco Systems, CSCO. Cisco, a $223 billion blue-chip stock and Dow Jones Industrial Average component, pays a 2.8% dividend with a payout ratio of 60%. Throughout the pandemic, the company has raised its dividend for 9 years in a row and has remained a cash cow. Non-GAAP operating cash flow increased 2% year-over-year to $4.1 billion in the fourth quarter. Cisco also returned $2.3 billion to shareholders last quarter through stock buybacks and dividends. The communication equipment company, which essentially produces most of the plumbing that allows the internet to function, should be a long-term dividend investment. Number 8. Discover Financial Services, DFS. For the second year in a row, Discover Financial Services, a credit card firm, makes the top 15 dividend stocks to buy list. DFS is the smallest of the big four credit card firms, which include Visa, V, $497 billion, MasterCard, MA, $357 billion, and American Express, AXP, $125 billion, with a market capitalization of around $35 billion. In some ways, this puts DFS in a better position than the other competitors, as there is more market share to be had. DFS also offers the largest dividend of these four businesses, at 1.5%, and with more commerce moving online and away from cash, credit cards should continue to gain market share in 2021. DFS has an unusually low payout ratio of 20%. Number 7. Pepsico, PEP. PepsiCo, the beverage and snack behemoth, is another of the top dividend companies to buy in 2021, with great diversification across geographies and business categories. Pep's Frito-Lay North America division accounted for 28.6% of total sales in the 12 weeks ending March 10, trailing only its PepsiCo Beverage North America section, which accounted for 34.3%. Its main competitor, the Coca-Cola Company, Co., lacks a strong food and snack segment. And, whereas Coca-Ep's colas dropped 19% last quarter, PepsiCo's grew by 29%. Pep pays a dividend of 2.9%. Despite a disappointing performance this year, Pepsi is a best-in-class stock when compared to the larger Coca-Cola. Number 6. Iron Mountain, IRM. Iron Mountain is the first real estate investment trust, REIT, on this list, specializing on storage and information management. According to the corporation, it stores and protects billions of dollars in assets from over 225,000 organizations throughout the world. Because IRM is a REIT, it is exempt from double taxation. It is required to distribute 90% of taxable income to its shareholders in exchange for not paying corporation taxes. Iron Mountain is a good choice for investors who prefer consistent income over significant growth potential. Shares, which had been trading in a pretty narrow range leading into 2021, have outperformed the other 15 stocks on our list and now yield 5.9%. The company is thriving as it embraces the digital world more fully. Number 5. Johnson & Johnson, J&J. Johnson & Johnson is another of the few recommendations from 2020 that has been repeated on the list of best dividend stocks to purchase for 2021. J&J's stock did not perform as well as Abbvie's in 2020, rising about 11%. Johnson & Johnson, a blue-chip firm that has been a poster child for decades, is divided into 3 divisions: medical equipment, consumer goods, and pharmaceuticals. The consumer side of the business, which sells everything from Listerine and Tylenol to Pepsid and Band-Aids, is virtually indestructible and running well. In 2020, the company's medical equipment section suffered the worst setbacks, with segment sales falling 10.5% as hospitals cut back on surgeries due to the pandemic. In the first quarter, this began to improve, and J&J's main segment, pharmaceuticals, had a 7.4% increase in revenue. Number 4. J.P. Morgan Chase & Co. JPM. The year 2020 was a negative year for banks. Interest rates fell, reducing the crucial difference between what a bank spends to borrow money and what it charges for loans. Even the most valued bank in the United States, J.P. Morgan Chase & Co., was hit by those headwinds, sliding nearly 6% in 2020. For patient investors looking for a safer asset with a decent yield, this was an excellent buying opportunity. J.P. Morgan and other banking equities have profited from rising interest rates in early 2021. J.P. Morgan shares have outperformed the market so far this year, and the company continues to pay a 2.2% dividend. J.P. Morgan Chase & Co. reported a 25% gain in trading revenue, a 32% increase in deposits, and a 28% gain in assets under management in the third quarter, beating both revenue and profitability projections. With a payout ratio of 29%, the dividend has lots of space to expand. Number 3. Abbvie. Abbvie, the Parma-based pharmaceutical company, is a repeat inclusion among the 15 best dividend stocks collection, having already made the list in 2020. Last year, Abbvie stock earned its superlative, rising by around 28% in 2020. Abbvie presently sells Humira, the world's highest-grossing blockbuster medicine, which treats a variety of conditions including arthritis, Crohn's disease, and plaque psoriasis, and has a market valuation of more than $200 billion. The company's acquisition of Botox maker Allergan, which is expected to completion in mid-2020, adds to its portfolio diversification. Abbvie provides a 4.5% dividend, which is very attractive. The research-based pharmaceutical company has a diverse healthcare portfolio that addresses some of the world's most serious diseases. The organization primarily performs research in immunology, neuroscience, virology, and oncology. More than 52 million people in over 175 countries rely on Abbvie's therapies on a yearly basis, according to the company. We may look at its most recent fiscal quarter to obtain a better picture of this. Abbvie kicked off fiscal year 2021 with a bang, reporting good results in the first quarter. The company's total sales for the quarter increased by 50.95% year-over-year, totaling more than $13 billion. This was followed by a significant 18% increase in net income over the same period. Abbvie also had over $9.7 billion in cash on hand at the conclusion of the quarter. Number 2. GEF. GEF, the smallest firm on our list with a market capitalization of about $3 billion, can add some mid-cap diversity to a dividend portfolio as the smallest business on the list. GEF is a moderate grower, but it offers a decent blend of income and steady growth, with a dividend of 2.7% and analysts anticipating earnings per share, EPS, to climb 10% annually over the next 5 years. This manufacturer of steel and plastic drums, corrugated sheets, container liners, and other behind-the-scenes packaging items is already benefiting from improved demand as the global economy improves. GEF's products are used by companies in a variety of industries, including pharmaceuticals, petroleum, food and beverage, and chemicals, to mention a few. Number 1. Target Corp. Although its 1.3% dividend yield may leave more to be desired for most income investors, be assured that it is one of only 2 of 15 options yielding less than 2%. Target is coming off a strong year in 2020, when its stock continues to benefit from its expanded focus on digital sales. Target unveiled a $7 billion multi-year investment plan in 2017 to become more digitally savvy, and those investments are already paying off handsomely. Digital comparable sales increased by 118% last quarter, following a 155% increase the previous quarter. TGT's payout ratio, or the percentage of profits utilized to pay the dividend, is only 31%, indicating that the dividend is safe and has capacity to expand. What are your thoughts on our video? Which of the stock do you want to buy from our list? Please let us know in the comment section below. If you enjoyed this video and would like to hear from me again, please subscribe and turn on the notification before leaving. Thank you for watching us.